Mackenzie Johnston with Cattle News Central, bringing you your December 17th cattle industry headlines. Brought to you by Ag Risk Advisors. They provide risk management programs to livestock producers all throughout the West. Whether you are talking about price or weather risk, Ag Risk Advisors, they are here to help. With current day market fluctuations, there is nothing more important than locking in a price floor on your cattle. So if you would like to learn more about an LRP, go ahead and reach out to an advisor today. Also sponsored by Circle 5 Cow School. If you're wanting to learn how to preg check your own cows or start AIing, Circle 5 Cow School is the way to go. Almost every week they are hosting courses from Texas to Tennessee. If you would like to view their schedule, head on over to circle5cowschool.com. That is the number 5 in there, or you can go ahead and just give them a follow on Facebook. According to The Guardian, the Dutch government has announced a $28.3 billion plan to radically reduce the number of livestock in the Netherlands as the country struggles to contain an overload of animal manure. The Netherlands has the highest density of livestock in Europe with more than 100 million cattle, chickens, and pigs in total. The deal to buy out farmers in hopes of reducing levels of nitrogen pollution has been kicked around for a while, and it finally was confirmed earlier this week after the agreement of a new coalition government. Obviously, this plan, the first of its kind in all of the world, is facing some major pushback from farmers who have taken to the streets to protest in recent years over tough regulation and farmer buyouts. Farmers worry that permanent damage to food production will occur in the Netherlands if too many farmers are forced to quit. The 13-year multi-billion-dollar voluntary plan, so this is a voluntary plan, it will pay some Dutch livestock farmers to relocate or to exit the industry. It will also help others transition into more extensive methods of farming with fewer animals and a bigger land area. The goal of this plan is to reduce the number of pigs, cows, and chickens in the country by about a third. U.S. Cattle Buyers Weekly has reported that, as we all know, meat giants like JBS and Cargill experienced all-time record profit margins this year for their U.S. operations. But something that you may not be aware of is that packers down in Australia, they have dealt with some of the biggest losses in a generation this year. According to a report from earlier this month, average monthly processor margins in Australia slid from a loss of $357 a head in September to a loss of nearly $433 a head in October, the worst monthly margins on record since early 2000. As of today, the 2021 annual average margin loss for packers in Australia is $321 a head. So here in America, it is a different story. During the first 9 months of this year, packers made an average of $562 a head, according to Hedger's Edge. When we break that down into quarters, in the first quarter, they averaged a profit of $301 a head. In the second quarter, they really hit things off and averaged a profit of $698 a head. Third quarter, $688 a head. So obviously the fourth quarter is still out, but in October, packers saw profits of $580 a head, and in November, they saw profits of $452 a head. So when we take a look at Tyson's 2021 stunning profits from their operations here in America, the meat giant reported an operating income of $1.147 billion in its fiscal fourth quarter, which beat the company's previous record of $1.12 billion set in the prior quarter. The meat giant's operating income for the year was a record $3.24 billion, twice the previous record of $1.58 billion set in fiscal 2020. Tyson has managed to pull off 4 consecutive years of operating income in excess of $1 billion. Things are going pretty well for them, I'd say. That is all I have for you guys this morning. That is all I have for you this week. I hope you all had a great week. Have a wonderful weekend. I'll see you next week.